Good morning, and thank you to everyone for joining us today for our webinar, Updates Around Paycheck Protection Program Forgiveness. At this point, I'd like to hand it over to Chris Hines to begin today's presentation.
Thanks, Jared, and thank you everybody for your time this morning. We appreciate it. I'll try to be pretty brief because we have a lot to cover. There's a lot of content in here. And we tried to make this presentation very practical as you start to go through the application process. Bloom Shapiro is a regional accounting firm based in New England, and we have an audit, tax, and advisory practice. I'm one of the advisory partners. And what we did about 6 months ago was we developed a team that was solely focused around PPP. So we've got experts that keep up with the rules, the changes, the guidelines, and then we have execution teams that have been working with clients daily on the forgiveness and the application process. What we tried to do within this presentation, and thank you for your questions in advance, is we tried to provide answers to most of those questions. If you feel like we didn't address your specific question, feel free to reach out to any of us after the presentation. What I'll do is, before Christine and Stephanie go through their respective parts, they'll each give you a brief introduction and highlights on their backgrounds. Just a quick overview. So in April, the PPP program was put in place as part of the CARES Act, really with the goal of protecting jobs and preserving headcount. The SBA issued numerous rounds of guidance, answering lots of questions. There's a few that are still unanswered. We'll cover those when we get through the content. In early June, there was a bill passed called the HR 7010. A few days later, there was an important correction that came out relative to the cliff rule of how the funds were spent. Mid-June, the revised application came out with the EZ form and instructions. Again, multiple rounds of frequently asked questions have been released. And what we've done is we've been working hard for the last 4 or 5 months with clients on forgiveness, helping clients maximize forgiveness, looking at projections, going through various scenarios on how to use the funds and spend the funds, and then putting together an overall game plan on how they would go through their forgiveness process. We've also been in contact with many of the banks over the last couple of months. I think some of the banks are up and running. I actually received 2 emails last night from clients that their banks had their portals ready to accept applications. I think some of the responses we've received have differed. A few of the banks are still testing and gathering information. They're using sample clients and sample applications. A few of the larger banks are waiting for more guidance from the SBA before they actually go live. We've heard that some banks are ready today, and we've heard from a few of the banks that they're not going to be ready until September. All of them have said they're going to process the applications in waves just because there's so many of them. The volume is tremendous. And once they're submitted, the guidelines are the bank has 60 days to review the application, and then the SBA hopefully will be able to do their review in 90 days. So that's just a general overview and background. I will pass it over to Stephanie right now to talk about the necessity.
Sure, thanks, Chris. Just wait a second so I can advance the slides, if that's all right. I think that's what you were just talking about with the update from the banks. Okay, here we go. So good morning, everyone. As Chris stated, I'm Stephanie Baton. I'm a partner in Hinckley, Allen and Snyder's corporate practice group. Hinckley is a multi-service law firm. We have offices throughout New England and the Northeast and Chicago. although our clients are both national and international. We offer a full range of legal services with our practices, including construction, corporate, litigation, real estate, and trust and estates. And we pride ourselves in general on providing very practical and business-minded counseling. So while my primary practice is in mergers and acquisitions and general corporate work, both I and a broader team at Hinckley Allen have been closely following and advising clients across all of our practices on pretty much all things PPP since its inception, helping folks navigate all of the various twists and turns along the way, including most recently loan forgiveness. One of the topics that we get the most questions about is actually the necessity of the loan certification, as we're calling it. This certification, or this morning rather, I'll walk you through the history of that certification, where we are today, and what we think borrowers should be thinking about when it comes to that certification. So the CARES Act itself, when it was passed in late March of this year, contained the very certification that's caused so much confusion. The legislation, or the language itself in the legislation, provided that an applicant must make a good faith certification that the uncertainty of current economic conditions make necessary the loan to request to support ongoing operations of the business. So it was inartfully worded at best to start with. There was no guidance provided with respect to what exactly this certification meant. And what made things additionally confusing is that the CARES Act, in a separate section, expressly provided that a borrower be unable to maintain credit elsewhere, which is a typical requirement under certain other SBA loans. So given the fact that it did away with this requirement, the logical assumption was that the certification could not mean that a borrower must not be able to obtain money elsewhere in order to qualify for a PPP loan. So at that time, late March, early April, given that there was an incredible amount of uncertainty in economic conditions, the lack of any guidance or objective measures from the SBA as to what it meant for the loan to be necessary, and the fact that the PPP was a first come, first served basis program, pretty much everybody comfortably made the certification and moved ahead quickly with their loan applications. So subsequent to the rollout of the PPP, there were increasing reports, which I'm sure you all saw, of larger publicly traded companies that applied for and received these loans because they technically qualified under the relaxed eligibility requirements. In the wake of these alleged abuses of the program, almost a month later, or after the passage of the CARES Act, the SBA started issuing guidance about this certification in the form of newly added questions to its running list of FAQs. Specifically, in its answer to FAQ 31, the SBA provided that borrowers must take into account when making this particular certification their current business activity and their ability to access other sources of liquidity sufficient to support their ongoing operations in a manner that is not significantly detrimental to the business. They underscored the need for the borrowers to consider this certification carefully and to make it in good faith. They added one example stating that a public company with substantial market value and access to capital markets would unlikely be able to make the required certification. It later followed with an FAQ clarifying that this guidance applies not only to public companies, but to private companies as well. In addition, the SBA included a statement that a borrower that applied for a PPP loan prior to the issuance of that guidance and repaid the loan by mid-May would be deemed by the SBA to have made the required certification in good faith. In other words, borrowers who made the certification prior to the issuance of the guidance were still going to be held to the later issued guidance if they did not return the loan. So this was unique in the aspect that it made this particular guidance retroactive in nature. It applies even if you submitted your loan application prior to the issuance of FAQ 31. And this is what changed the landscape and seemingly moved the goalpost for eligibility of a PPP loan. So a few important things to note about this guidance. Although the wording of the certification itself did not change, the guidance specifically directed applicants that they need to consider other sources of liquidity, sufficient to support ongoing operations in a manner not significantly detrimental to their business. These were new standards, for sure. They did not provide any financial metrics or other objective criteria by which to measure yourself against these standards, however, leaving it difficult for you to determine whether or not you met the standards. In short, there's no bright line financial metric or economic test. So in terms of the SBA review of this particular certification, they followed up with guidance in the form of FAQ 46 that stated that any borrower that, together with its affiliates, received PPP loans of less than $2 million would be deemed to have made this certification in good faith. So this was good news for borrowers under this threshold, as this seemingly means that the SBA will not review the basis for your certification. The guidance went on to say for the borrowers that do not fall below this threshold, you may still have an adequate basis for making the certification depending on your individual facts and circumstances. For those borrowers, the SBA went on to say that if they ultimately disagree with your determination on your necessity of your loan, then as long as you repay the loan upon notice from the SBA will not pursue enforcement action. So on the one hand, this isn't great news because repayment of the loan is not what most borrowers expect. However, what this did do is alleviate many borrowers' fear of being charged with fraud. The remedy in the event the SBA disagrees with your certification seems to be to return the funds. What's important to note, however, is that this particular guidance regarding SBA's review only applies to SBA's review of the necessity of the loan certification. Keep in mind that the SBA is still free to audit other aspects of loans in any size, including looking at other eligibility requirements, for instance, whether or not you correctly applied your affiliation rules in determining your number of employees. So in terms of what this means for borrowers and what you need to do, the instructions to the PPP loan forgiveness application set forth a list of documents that each borrower must maintain in its record. This list includes documentation supporting your necessity of the loan certification. Although this document does not need to be submitted to the bank with your application, you should have it on hand in case the bank or the SBA requests it in its review of your file. Therefore, taking all of this into account, if you haven't already done so, you should carefully consider and document the basis upon which you made the certification, taking into account the limited amount of guidance issued by the SBA that we just discussed. As mentioned, this will be case-by-case, fact-specific analyses based on your business's own facts and circumstances. Generally, however, we think it's helpful to consider the following factors in considering the basis upon which you're making the certification in order to show your necessity of the loan. First is the financial impact to your business of the COVID-19 crisis. So in other words, was your business actually negatively impacted as a result of the pandemic, or was there a real and reasonable potential in, early April or at the time that the subsequent SBA guidance was issued in May, that your business would be potentially negatively impacted. So for potential negative impacts, the impact should be real, should be immediate, and should be articulable, and not just hypothetical. In the course of your thought process and in your documentation, you should also try to explain and demonstrate those impacts. Consider, for example, whether or not you had any losses in sales or declines in other key business metrics. Make the link in your document between the financial impact of COVID-19 and those negative impacts. For instance, did your business or your customer's business have to close as a result of government shutdown orders? I say this as opposed to it just being a bad year or a down year for your business for non-COVID related factors. Most people are able, with some exceptions, are able to, clearly and easily document this. You can also consider things like other adverse financial impacts on your business, perhaps significant increases in costs due to you having to implement COVID-19 safety measures. So generally, think carefully about how your business was impacted, or how you reasonably feared it might be impacted, and then document it. The second factor that we think it's helpful to consider and then document is personnel decisions. So this is keeping in mind the fact that the legislation is called the Paycheck Protection Program, and as Chris pointed out, was really meant to keep people on payroll, put money in their pockets rather than laying them off, even if you happen to be paying those employees to stay at home rather than work. So consider and document what your business would have done were it not for receipt of the PPP loan. In other words, would you have laid off people or furloughed them or reduced their pay? If you would have and you didn't as a result of the PPP, or if you did and then brought people back as a result of receipt of your PPP loans, then you seemingly did exactly what Congress intended, and you should document that. Oh, let me go back one slide. So the last factor, and these are general, again, these are just buckets to help your thought process, but the last kind of factor we'd like to highlight that you should consider is unfortunately the wild card. So that's the language in the SBA guidance that says that you need to take into account access to other sources of liquidity that could support your business in a manner not significantly detrimental to your business. So as we discussed, no one knows exactly what this means, unfortunately. However, it can't be ignored because they specifically drew attention to it in the guidance that they issued. So you should consider any other sources of cash you may have on hand, whether or not that's in your bank account, it's a line of credit, or otherwise. And then think through and explain why you could not have used those sources without significantly and detrimentally affecting your business. Now, for most of the clients that we speak to, they have some other source of liquidity. And really all it takes is, asking yourself the question, why would I not have used those? And in the course of that conversation, what comes out is a number of entirely reasonable business factors that explain why that wasn't either appropriate or advisable from a business perspective. That analysis actually, as we found out, really differs business to business. So some examples we've seen are perhaps if in your business or industry, in order to win jobs, you have to have a strong balance sheet. So drawing down on your lines of credit or depleting cash would prevent you from getting any future jobs and therefore jeopardize your business and the jobs of all of your employees. Then that's something you'd want to explain. Perhaps you have credit facilities in place that have financial covenants that come with severe consequences if you violate them by depleting cash or levering up. Or perhaps the cash on your balance sheet is offset by a large liability. Again, very facts and circumstances specific, and will likely not look the same for any two borrowers. So this is what we know about the uncertainty of the loan certification, at least at this point. We understand that these answers are less than ideal and there remains a lot of uncertainty. Until the SBA begins to review the loan forgiveness applications, which should start happening in the near future, as Chris pointed out, or until they issue more guidance, we won't have any more answers as to how exactly they're going to apply that standard. One thing, however, we'd like to remind you of is that if you are contacted by the SBA in connection with an audit or review of your loan, whether it's this certification or for any other reason, we highly, highly recommend that you contact your legal counsel immediately for assistance in responding, regardless of how benign that inquiry might seem. Just politely say you're happy to help and be responsive, but you'd like to talk to your legal counsel first. That way you can get ahead of the game and make sure that it's handled in the proper fashion. So should anyone, as I've said, I think multiple times in this presentation, the necessity of the loan analysis really does depend on your facts and circumstances. So if anyone wishes to discuss, your individual fact pattern with respect to the necessity of the loan certification or any other aspect of loan forgiveness, we are here and we are more than happy to help. So with that, I will hand it over to Christine to talk in more detail about loan forgiveness.
Thank you. So I'm Christine Demena. I am a principal in our advisory practice at Bloom Shapiro. And for the last several months, I've been pretty much solely focused on assisting clients with their PPP forgiveness analysis and assisting with drafting applications. Before I dive in, I want to again thank everyone who submitted questions. We've tried to incorporate as many as possible into this presentation. The rules for the PPP have been constantly changing since it was first available in early spring. Many questions have been clarified through the Flexibility Act, interim final rules, the actual forgiveness applications, and multiple rounds of FAQs. One important clarification was regarding what the definition of payroll costs is for inclusion in the forgiveness applications. And it's been clarified that payroll costs can be paid or incurred during your covered period. So if you are under an 8-week covered period, anything paid and or incurred can be counted. An example of where this can be beneficial is if your covered period started on April 15th and you paid employees on April 15th for the prior 2 weeks worked, that entire payroll can be included in your forgiveness application calculations because it was paid in the covered period. On the flip side, if you had a payroll that spanned to the end of your covered period, but wasn't paid until after the end of your covered period, you would include the portion that related to the covered period in your forgiveness application. So in some cases, this does allow you to get more than the original 8 weeks of costs into your application under the 8-week covered period. The benefit of this diminishes slightly with the 24-week covered period option, as you have a lot more time to get your costs in. Employees who are not performing work but are still being paid can also be counted in the forgiveness application. And to determine how those payroll costs were incurred, you would look at the schedule normally set by the borrower. So if you typically had a person working Monday through Wednesday, those are the days you would assign the cost to for purposes of the application, as well as what the scheduled hours would have been. You also have the ability to apply the same theory to non-payroll costs. Again, you can include costs that are paid or incurred in the covered period. For example, if you had a water utility bill that was paid in July and it related to April and May, you could include the portion related to your covered period, if that was April and May, in the forgiveness application, even though it wasn't paid until the next billing cycle in July. Wages paid to furloughed employees also can be counted in the forgiveness application, as well as bonuses and hazard pay to employees, but not to owners. In addition, the gross pay paid to employees is capped at $100,000 based on an annualized amount. So this equates to $46,154 over an entire 24-week covered period and $15,385 under an 8-week covered period. Originally, you had to use 75% of the funds on payroll and related costs, but now that has been reduced to a 60%. The Flexibility Act was enacted June 5th, and it was meant to give more freedom on how and when you can use your PPP funds. Many of the components in the Act were retroactive. There are also new exceptions added to allow for full forgiveness, even if you are unable to restore your FTEs to pre-COVID levels. One of the first changes was extending the period to replace and restore FTEs and salaries. The original date of June 30th now has moved to the earlier of December 31st and the date the forgiveness application is submitted. There's also a safe harbor where if you restored your salaries and wages to the levels as of February 15th, prior to the end of 2020, you would not have a reduction in your forgiveness, even if your average FTEs during their covered period were lower. But you must have a decrease in the interim to use the safe harbor, and we'll talk about that later. An important addition was loan forgiveness would not be reduced if you had a loss of FTEs due to guidance and requirements established by Human and Health Services, the CDC, or OSHA, and those related to standards of sanitation, social distancing, and other safety requirements related to COVID. Later guidance also clarified that this includes indirect guidance coming from the state and local governments and shutdown orders. If you received your PPP loan prior to June 5th, you can still elect to use an 8-week covered period. And all borrowers have the option to submit their forgiveness application prior to the end of the covered period. So if you have extinguished all of your PPP funds, say in week 12, you do not have to wait until the end of the 24 weeks to apply for forgiveness. However, if you do apply early and you had a reduction in individual employee salary or wages in excess of 25%, you do have to extrapolate that reduction over the entire covered period. Certain payroll tax payments that have been deferred can now still count towards forgiveness under the PPP loan, even though they're not technically paid in the next billing cycle. The loan maturity date has also been changed from 2 to 5 years for all loans made after June 5th. This is one aspect that was not retroactive. So if you have a loan that was issued prior to June 5th, your maturity date is still 2 years unless you and your bank can mutually agree to extend the maturity. Self-employed individuals, general partners, and owner employees cannot include health insurance contributions or retirement contributions since those are already included in their compensation. And their caps are a little bit different, which we'll talk about later. So the big round of FAQs was issued on June 25th, and the long-awaited next round didn't come out until August 4th. There were a few additional clarifications released August 4th. One related to the fact that you are not allowed to accelerate costs related to employer contributions for retirement or healthcare premiums that are outside the covered period. So you cannot prepay items that you wouldn't normally be paying in that period and include them for forgiveness. There is an alternative covered period that borrowers who pay their employees on a biweekly basis or more frequently can elect. And rather than starting their covered period on the date of the loan disbursement or the date that it's deposited into your bank account, you can elect to start your covered period on the first day of the first pay period following the loan disbursement date. And the purpose of this is to eliminate the need for those borrowers to prorate their pay periods, and it really aligns their covered period with their payroll. However, it was clarified that if you choose to use this alternative covered period for your payroll costs, you still have to use the regular covered period for your non-payroll costs, and that would start on the date of the loan disbursement. These FAQs also clarified that any interest on unsecured credit is not eligible for forgiveness because it is not secured by real or personal property. And interest on the loan starts accruing on the date of the loan disbursement. There were a few more FAQs released on August 11th as well. So next I'm going to get into the actual forgiveness applications. The forgiveness applications are available on the SBA website, and there are 2 application versions. One is the easy version, and one is the full application version. As Chris mentioned earlier, some banks have started accepting forgiveness applications. In the forgiveness applications, you have to choose either an 8-week or a 24-week period. And again, the covered period either starts on the date of the loan disbursement, or for biweekly or more frequent payroll employees, you could start on the alternative covered period. And again, under the 24-week option, you are allowed to finalize and submit your application before the end of the covered period, but you do have to extrapolate any salary or wage reductions in excess of 25%. The forgiveness applications also allow you to obtain full forgiveness even if you did have FTE reductions, if you have enough eligible costs within the covered period to absorb that FTE reduction. You have 10 months from the end of your covered period to apply for forgiveness. As it was mentioned earlier, any loan over $2 million will be audited by the SBA, although they do retain the right to audit any loan, regardless of the loan amount. You also do not have to include all of the costs in the forgiveness applications. For example, if you could choose to only include payroll costs, if that achieves full forgiveness, and not include any non-payroll costs such as utilities, rent, or interest. Even if you're including payroll salaries, you could still choose not to include retirement contributions or healthcare. So it's only the costs that you're seeking forgiveness for that should be included in the forgiveness application. And again, you need to have at least 60% of your funds spent on payroll and related benefits in order to achieve full forgiveness amount. So first, we're going to talk about the easy form and how you can use that form. So there's 3 options that if you're able to check one of the options, you can use the easy form. The easy form is much shorter and does not require you to submit the detail on an employee by employee basis. So option number 1 is if the borrower is a self-employed individual, independent contractor, or sole proprietor who had no employees at the time of their original loan application and did not include any employee salaries in their computation of the average monthly payroll when calculating their original loan amount. And it should be noted that you are required to retain all the records submitted with the original loan application for at least 6 years after your loan is forgiven or paid in full. The second option to use the easy form requires you to meet these 2 certifications. The first is you must not have reduced annual salaries or hourly wages by more than 25% during the covered period related to the period between January 1st and March 31st of 2020. So this is individual hourly wage amounts and salary amounts on an employee by employee basis. And you also must not have reduced the number of employees or the average paid hours of these employees between January 1st and the end of your covered period. You do not get penalized for reductions that arose from an inability to rehire individuals who were employed on February 15th if you could not rehire similarly qualified employees on or before December 31st. You can also ignore reductions in an employee's hours that the borrower offered to restore and they refused. However, you must support these certifications. And to do so, you are required to retain payroll records that separately list each employee and the amounts paid to each employee during the period January 1st to March 31st and the covered period. You also must have documentation regarding any employee job offers and refusals to accept restoration of reductions in hours, firings for cause, voluntary resignations, written requests for reductions in work schedule, and the inability to hire similarly qualified employees. And lastly, you must have documentation supporting the certification that the borrower did not reduce the number of employees or the average paid hours between January 1st and the end of the covered period. And again, this documentation must include payroll records separately listing each employee and showing the amounts paid to each employee between January 1st and the end of the covered period. The third option to use the easy form also has two certifications you must meet. The first is that you did not reduce annual salary or hourly wages by more than 25%. And the second is that you are unable to operate at the same level of business activity as you were before February 15th due to the compliance with requirements established or issued by HHS, CDC, or OSHA. And again, this includes state and local government shutdown orders as well. To support these certifications, again, you need the payroll records separately listing each employee and amounts paid in the periods to January to March and the covered period. And to support the second certification, you have to have copies of the applicable requirements for each of your locations and your relevant borrower financial records. So although the easy form is shorter and does not require you to submit detail on an employee basis like you do in the full form, you still have to accumulate a significant amount of support and retain the support to be provided to authorized representatives upon their request. For the full version of the application, if you do not qualify for the easy form, you complete the full version. So this form has several FTE, so full-time equivalent, safe harbors that if you can meet one would exempt the company from a reduction in forgiveness, even if you did have a reduction in your average FTEs during your covered period. The first option is if you had no reduction in employees or the average paid hours between January 1st and the end of the covered period. The second option, which is called Safe Harbor 1, is a certification related to the inability to operate at the same level of business activity. And lastly, Safe Harbor 2 compares the FTEs in the period inclusive of February 15th to the earlier of December 31st, 2020, and the date the application is submitted. So to use this safe harbor, you must have had a reduction in your average FTEs during the period from February 15th to April 26th, and then have restored them back. And again, to utilize any of these safe harbors, you must retain all of the necessary support. In calculating your FTE reductions and looking at the safe harbors, again, you are not penalized for reductions due to these types of items such as voluntary resignations, terminations for cause, written requests for reduced work schedules, etc. But you must have written records for each of these on an employee by employee basis to not include them as an FTE reduction. If you're unable to meet an FTE safe harbor, you must compare the average FTEs during your covered period to one of the following look-back periods. The first is February 15th, 2019 to June 30, 2019. The second is January 1st, 2020 to February 29th, 2020. And the third is an option if for seasonal employees, they can use either of those periods or any consecutive 12-week period between May and September 2019. But it should be noted, a recently issued FAQ contradicts this a bit, and I'll talk about that towards the end. You're allowed to pick the look-back period that is most advantageous for your calculation as well. So the loan forgiveness application seems straightforward, but besides all of the various dates listed in the applications, the FTE calculations in particular can be quite confusing. So the first question is, how do you calculate what an FTE is? It's been defined that an FTE is based on a 40-hour per week work week. So any employee who works 40 hours or more would be a 1. You cannot be higher than a 1. And any part-time employee would be converted by dividing their weekly hours by 40. There's a simplified method that counts each part-time employee as one half, regardless of the hours worked. And these average hours worked per week drive the overall FTA calculations for the covered period and for your look-back periods. So you have to do this on an employee by employee basis. So the more employees you have, the more cumbersome and time consuming this can be. And again, you do not get penalized for certain reductions, but have to document all of those situations. In addition to the FTE reduction calculation, there is a salary and wage reduction. So this should be completed only for employees whose salaries or hourly wages were reduced by more than 25% during the covered period as compared to January to March. And this is based on their average annual salary or hourly wage, not the number of hours worked in the period, because that's already addressed through the FTE reduction calculation. And it appears to be calculated on their base rate, not overtime rates. So once you get into the payroll application, the biggest area is the payroll costs. You include gross pay per employee. It's not net pay, it's gross pay for each pay period paid or incurred in your covered period. These are subject to caps based on $100,000 of annualized salary, which is again from $15,385 upwards to $46,154 based on your covered period. We assume that you would prorate for any periods in between 8 and 24. For example, if you submitted early in the 24-week period at week 12, you would not be using the $46,000 cap, but rather a prorated portion of that. And the gross pay does include tips, severance, bonuses, commissions, and paid leave, except leave already covered by FERCA. And any entities receiving other grant funds should just be cautious to not double dip. You cannot apply for forgiveness for funds that were obtained through other federal sources, for example. So that is the cash payroll cost subject to the cap per employee. You also include in your payroll costs any employer, state, and local taxes, employer paid retirement contributions, and employer health care costs. So those are in addition to the gross pay, and they're not counted towards the per employee cap. Healthcare costs include premiums for medical, dental, and vision, and this includes employer premiums for self-insured plans as well. They've explicitly stated that life insurance and workers' comp are not eligible costs to be included, and disability insurance has remained a gray area. Out of caution, I've seen most companies not including those. Schedule A in the full forgiveness application is where you list out each employee and their compensation. So you have to include any employee employed during the covered period whose principal place of residence is in the US. And I know there were some questions on how to determine that. One of the FAQs has released some guidance and referenced the IRS regulation to consult when determining the answer to that question. Schedule A has two tables. Table 1 is for employees who receive compensation at an annualized rate of less than or equal to $100,000 for any pay period in 2019, or they were not employed by the borrower in 2019. Table 2 is only used for employees who receive compensation at a rate of more than $100,000 for any pay period in 2019. Employees who received over $100,000 annualized in 2020 that did not receive that amount in 2019 should still be included on Table 1. So owners should not be included on Schedule A. They're part of the owner compensation. Their cap is a little different. For the 8-week covered period, it's the same, $15,385. But for a 24-week covered period, they're capped at $20,833, not the $46,000. And this is in total. So if you have multiple businesses with PPP loans, you can only apply for a maximum of $20,833 per individual. And there is some specific guidance addressed on the SBA website related to owner compensation. So to compute the amount to put in the forgiveness application for owner compensation, it's based on the maximum, the minimum of the cap. I'm sorry, you cannot go above the caps just discussed, but the actual calculation is based on 2.5 months out of 12 of your 2019 cash compensation, net profit on Schedule C, or your net earnings from self-employment. So if that amount is less than the cap, you have to use that amount instead. And as we mentioned, separate payments for health insurance, retirement, etc., typically are not eligible as they're already included in your compensation. So that's the payroll side. Then you have the ability to include non-payroll costs in the forgiveness application. This includes utilities, rent, and interest on obligations secured by real or personal property. Utilities, which is water, electric, gas, etc., also includes an item called transportation. And this has been defined as gas for business use vehicles. It has not been defined to include items such as repairs or any other vehicle expenses. As I mentioned, interest on unsecured loans is not eligible for forgiveness. And just like the payroll costs, these non-payroll costs have to be paid or incurred in the covered period and paid in the next regular billing cycle. Lease payments included both principal and interest for capital or operating leases in effect prior to February 15th. And that can be equipment, copiers, office space, etc. And for all of these non-payroll costs, they should have been in effect prior to February 15th. So even with all of the guidance that has come out, many questions still remain. In general, borrowers can calculate their aggregate payroll costs using data from either the previous 12 months or from calendar year 2019 when they were calculating their original maximum loan amount. For seasonal businesses, there was an alternative period that they could use to calculate their maximum loan amount. The guidance for these seasonal employees is currently inconsistent in regards to their FTE look-back period. So one of the latest FAQs indicated a seasonal employee who calculated their maximum loan amount using the alternative period has to use that same alternative period as their reference period in the forgiveness application. So using that for their look-back period for their FTEs. Whereas in the forgiveness application, you have the option to use either the February to June of 2019, the January to February of 2020, or in this case of a seasonal, they have a third option to use that alternative period. So it's still unclear between the various guidance as to which period they have to use or if they have a choice. We're assuming the covered period ends when the funds are used up, which is no later than December 31st. And some banks are having issues accepting the 24-week applications early due to the lack of SBA guidance, although the regulations and the forgiveness applications both allow you to do so. The definition of real and personal property for interest inclusion is unclear. So is that defined by the IRS? Defined by state statutes? That remains a question. And there's been an overall lack of guidance on the tax treatment. So the assumption is that forgiven expenses are not deductible, but there's also unclear guidance as to what period you would deduct, include the income or the expenses for tax purposes. Going to take a few minutes here to talk about how to account for forgiveness. Forgivable loans are a form of government assistance, and US GAAP addresses how to account for government assistance for nonprofit organizations, but does not address how to account for government assistance by for-profit entities. So there's several different accounting alternatives, and I'll talk about the debt model, the government grant, and the gain contingency model. So first, the debt model. So any PPP loan recipient can apply the debt model, regardless of their intention to seek forgiveness, because the legal form of the loan is a note payable. So the proceeds of the loan are recorded as debt, and the classification in the balance sheet would be based on the repayment terms of the note. Forgiveness would be recorded upon legal release by the lender, which could take a while. Your measurement period can be up to 24 weeks. The bank has up to 60 days to process. The SBA has 90 days to review. But once that's completed, you would record the amount as a gain on extinguishment of debt on the income statement. So in the case of a June 30th year end, you may have incurred most of your expenses in fiscal year ended June 30, 2020. However, you would not be taking the loan into income until 2021. So there is some disconnect to the matching principle of expenses and income. However, the debt model is allowed by current US GAAP. The second is accounting for it as a government grant. So for a nonprofit entity, they would record the proceeds as a conditional contribution, and that would show as deferred revenue or a refundable advance on the statement of financial position. You would record the forgiveness as contribution income when the barriers to recognize the income are overcome. And the barriers here would include incurring the qualifying expenditures and maintaining your FTE and salary wage levels during the measurement period. So you actually have to meet the conditions in order for them to be overcome. So in the case, again, of a client with a June 30th year end, your covered period could end July 15th. In this case, you would have incurred a significant amount of the qualifying expenditures through June 30th. However, you cannot say you've maintained the FTEs or the salaries because you still have 2 weeks to go in your measurement period. So in this case, you would calculate the amount of eligible qualifying expenditures you would expect to be forgiven, but in your FTEs, you would assume 0 FTEs for the period after June 30. So this would allow you to take at least a portion into income for your year ended June 30, 2020, and the rest would be recognized in the following year if they were forgiven as well. Under international accounting standards, there's a similar model that can apply to for-profits. Again, it would be recorded as a refundable advance, and forgiveness would occur when it's reasonable assurance that forgiveness will occur. And what that means, you record it in the period where the forgivable expenses are incurred, provided that it's likely those will be forgiven. And lastly, under the gain contingency model, any entity can apply this model. The proceeds are recorded as a refundable advance, and you would recognize the amount when it's realized or realizable. And as a practical matter, this is likely near the date that the borrower is legally released by the lender. So I hope this helped to answer some of your questions, and I'm going to turn it back over to Chris.
Thank you, Christine. Thank you, Stephanie. We just wanted to thank everybody for their time this morning. We tried to make this working session, make it pretty practical, and hopefully it was helpful. You have each of our contact points, so if you have further questions, you want any follow-up, we want us to share any of the tools we have, feel free to reach out to any of us. But with that said, everyone have a great day, and thank you again for attending.